Now, I'll say, how many people in the room are short-term investors? I've never had anybody ever raise their hand. I mean, everybody in the world is a long-term investor until the market goes down.
Certainly most of the professional investors focus on what the stock is likely to do in the next year or two, and they have all kinds of arcane methods of approaching that. But the real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price.
You shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period, and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote. You don't need to pay attention to them.
A key success factor is you want to have enough money in the bank that you're going to survive, regardless of what's going on with volatility in markets. People who, one, you shouldn't borrow money. So if you borrow money, you own stocks on margin, markets are going down, and you have your livelihood at risk, it's very difficult to be rational. So key is getting yourself to a place where you're financially secure. You're not going to lose your house, right? That's a kind of a key thing. And then also doing your homework. Stocks can trade at any price in the short term. And if you know what a business is worth and you understand the management, you know it extremely well, it's not nearly as, it doesn't bother you when a stock price goes down, or it has much less impact on you because again, as Mr. Graham said, the short term, the market's a voting machine. You have a bunch of lemmings voting one direction. That's concerning. But if it's a great business, doesn't have a lot of debt, and people are going to just listen to more music next year than this year, you're going to do well.
Be prepared to, when you buy a stock, to have it go down 50% or more and be comfortable with it as long as you're comfortable with the holding. And I pointed out 3 times in Berkshire's history when the price of Berkshire stock went down 50%. There wasn't anything wrong with Berkshire when those 3 times occurred. But if you're going to look at the price of the stock and think that you have to act because it's doing this or that, or somebody else tells you, well, how can you stay with that when something else is going up or anything? You've got to be in the right psychological position. And frankly, some people are not really careful. Some people are more subject to fear than others.
Being in a place where you're investing money that you don't care about the price in the short term. It's money for your retirement, and you take a really long-term view. I think that's key.
In the securities business, you literally every day have thousands of the major American corporations offered to you at a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients start yelling, "Swing, you bum!" from the stands, and that's very tough for people to do.
The vast majority of investors, it seems, tend to be the ones that panic in the downturns, get over elated, and when markets are doing well.
So, be able to think long term and be sufficiently financially secure such that you can afford to think long term.
Yeah, Buffett is the ultimate long term thinker, and just the decisions he makes. The consistency of the decisions he's made over time and fitting into that sort of long-term framework is a very, very educational, let's put it that way, for learning about this business.